You're listening to the Right Club podcast, where the focus is all about helping you grow your real estate investment portfolio and live the life you want to live. Come grow with us and join our community at therightclub.com. And now your hosts, Sarah Larbi and Alfonso Salemi.
How easy is it for you to find people to actually go into the rent to own? I'm talking about the tenant buyers. Are you finding any difficulty there, especially now with the way things are?
Actually, two answers to that. Very good question. The way things are now is driving a lot more to us because banks, everybody says, well, rates are low. Great. But they also raise the bar for the criteria to get the loan. And so we tripled our business literally from April on, and it's still going all around North America because of that. And as far as finding them, even prior to COVID, there's such a big pool of buyers. In any given market, you'll have like between 60 and 82% of the buyer pool. If you took a snapshot in time, they can't get a loan today. They either don't have enough down for the criteria or especially in the United States, the credit criteria. So it just depends on the particular buyer, but there's always massive amounts. That's the easiest part. The harder part is to find the property. And once you do, you have an onslaught of people looking for terms. During COVID, we were like the only door open, so to speak, right? Because the banks got so tight. We have what we call jumbo loans right here. I don't know if it's the exact same in Canada, but over a certain price range in certain markets, it changes. Those are very difficult to get. That you have to be stronger financially and credit worthy. And that became very difficult. It almost became non-existent for a few months during COVID. Well, where did they go? They came to us for the higher end properties. That's what they did, because now they needed time to save more or time to get their affairs in order. So it's actually driving more and more buyers to us.
Yeah, and in Canada, I mean, the feds and the banks are constantly raising the bar and making it more difficult for people to qualify for mortgages, and yet there's a huge demand. I mean, we've like just the Toronto area right now is insane, and Vancouver, even though prices have gone up, there's still such a demand and around those areas because people are fleeing the cities. And
right, same.
It's ridiculous what's going on right now. There's so much demand. So many people want it, and yet it's harder and harder to get the financing.
Yeah, I have a gentleman in Canada that said, and I didn't know it was this set in stone. You guys can tell me if I'm wrong. He said that most banks won't do loans under 20% down. And so he was having a great level of success with the rent to own because he was getting nice deposits up front. They were expecting that. Is that the case, that 20% is pretty much the norm?
Yeah. So as an investment property, if you're buying an investment not to live in, it is 20%. If you're buying an investment like a duplex or even a triplex or a single, and you're planning on living in it, then you can get away with 5 or 10% with insurance, which is CMHC or somebody to insure that mortgage because you don't have the 20% down. But you're right. Like, it is a completely different market when you're looking at the US and Canada. I'll tell you, there's pros and cons to both markets.
Right.
For sure. I mean, we look at like our vacancy rates, and we look at, the market rent appreciation as an example. And over time, our appreciation, I think, is stronger than many places in the US. Yes, the prices are more expensive versus what you guys have. Yes, there's more regulations, but there's some stability too that some of our markets in Canada has that, maybe the US doesn't have as much, right? So you look at like 08 and 09, like something like that, like where our financing system and our bank system are very highly regulated. So versus like the US, where you guys have like lots of like small independent banks and different things like that. Like for us, it's like there's 6 major ones across Canada, across the whole country. Yes, there's B lenders and trust companies and that kind of stuff, but it's highly regulated. So it's, in a way it could be, it's better in the sense that you're not going to experience, I think, in Canada what you guys experienced back in 08.
Yeah, a little bit more steady.
Yeah. So what's like an average property deal that you do price wise, and like Brent, maybe run us through the numbers and what that looks like so we can dissect it.
Sure. So in my market, I'm always talking from my experience. So in our market, we're going to be somewhere in the 350 to 550 range. That's our sweet spot. Given that sweet spot, those 3 paydays I mentioned to earlier, we run around 75,000 US, all 3 of those paydays combined. We have students that run from a low of 45,000 up to $250,000 if they have a higher price range, because it's just a percentage basis. So a typical lease purchase deal, we call it a sandwich lease, where we have the lease purchase and then we have the rent to own. It's about a $75,000 deal. But the cool thing about that is I tell people, look, it's not 75 today, but you can sit there. And if you get your first 6 deals, say on a spreadsheet, and say, great, I now have this much coming up front. I now have this much monthly, you can, living expenses. And now I have this forecast of 2 to 5 years with all this back end payday 3 coming. So it's pretty predictable at this point, very proven and very profitable. That's a typical deal for us. Now, when you start talking about owner financing with that massive principal pay down, different metrics. Here's the metrics on that. If the home is $200,000 or more, so not that high end, and the payment monthly to the seller principal is $900 or more, and you can get at least a 4-year term, that's a 6-figure deal, all 3 paydays. $100,000 and up all the time, all 3 paydays. And we have students that just go after that niche on purpose for that reason. And then to your point earlier, I think one of you said something about rural, people moving out of the city, right? We had a gentleman in Colorado, Chad, who he was previously doing more things that weren't rural and free and clear. And all of a sudden with this change with COVID, his rural properties, his off the grid properties that literally aren't even on the grid with electric, are getting huge demand because people are fleeing, and he's got some phenomenal deals, all 6 figures and up. It's a pretty neat model when you start thinking about that. Yeah.
So when we go to the vendor takebacks, I like to call them vendor takebacks. So let's just say a student, or you've got somebody that's interested in figuring out this model. Like, what is the first step if they say, oh, I want to really ultimately do that route of a vendor take back and not necessarily have to come up with all of my own cash? What's the process of uncovering and negotiating that, and maybe walk us through that piece?
So in other words, literally speaking with a seller type thing.
Yeah. So how do you uncover it? How do you create interest, negotiates? What do you tell them essentially for them to say, wow, this makes sense?
Yeah. So this is all the sellers we speak with too, to this question. It's always trying to find why they're, the motivation, why they're selling. Because people say, well, do you try to convince them? No, we just try to find what their motivation is and then try to band-aid that or fix that, right? So on a free and clear, it would be the question right up front, Sarah, would be, okay, I see you're asking X, say $500,000. Do you need all that up front, or would it be advantageous, or could you wait longer term or take it over time if you got your full price or more? And usually that gets their attention, because if they needed money, they would have presumably taken it out, right, with a loan on the property. So if the answer is yes, or I'm open to it, then our discussion only becomes, viewing the property, of course, virtual or in person, but then the discussion only becomes, if you were to do this, how long could you go? Some people will say, well, I can't go 20. All right, great. So maybe we can go 15 or 10. Some people say, well, I can't go more than 2 or 3 years. So you try to get that term in mind. And why is that so important? Because if I'm paying monthly principal payments, and Sarah, let's say you said to me, I could go 10 years versus a 4-year deal. That principal pay down over those extra 6 years is massive. So I can easily say to you, well, you're asking $500. If I'm going to pay you $2,000 a month, I don't mind paying you an extra 6 months worth of interest in my mind, right? So $12,000 extra dollars or whatever it might be. This seller's never going to get a premium on the open market like that. Never, ever, ever. So that gets their attention. And so we just structured 2 or 3 different options showing 4, 7, 10-year terms, depending on the conversation. But each term that goes further out, the price goes up.
So they're obviously in their best, interest to say, wow, instead of getting $300,000 for this property, I may be able to get $450,000, but it's going to be in 10 years from now, essentially.
Well, that's a big jump, but yeah, I can get more than 300. Like, let's say I can go from 3 to 320 to 340, somewhere in that range if I'm pushing those 3 ideas. 450 be really pushing it.
Yeah, I mean, I think that's the big difference is like our appreciation, like just like looking at history, and you don't want to bank on that. But I think that's one of the big differences too with Canada or parts of Canada. I can't say every part of Canada, but let's just call it the GTA and I would say within a couple hour radius from some of the major cities across the country, our appreciation. So that 300 to 450 in 10 years, to me, like it could be, it's very, very probable that that's what's going to happen. But
yeah, I agree.
But when you look at some markets in the US, I would just say you guys have better cash flow in general, right? So like you can buy something, for Americans with a lot less down, but you can still get that 1% rule or that 2% rule, where for us it's, you know, it's not impossible, but it's definitely not common.
Yeah, so what we find with that, and that's a good point to hone in on and peel back a little bit. What we find with that is when you have a buyer pool, to back to the earlier question, and they don't have a way to get mortgage ready in their mind, like most of them have given up. I didn't think I could do that, or I was bankrupt and now I thought I needed to wait 10 years, whatever their reasoning is, they thought they were done. Once you have that mentality and that hope, that need or that desire to get their family in a home and eventually buy again, they tend to not pay too much or not as much attention to the pricing. They want a path. It's like in the US, when someone says, I can't get credit cards anymore, and some company offers them this credit card at astronomical fees. It's not quite that much because that's gouging, but the point is their mentality is different. Show me a path, show me a path. And they don't get caught up on what the rent might be, because they're in their mind, they're a buyer and they get the special path they can go on. So that's what we find in all markets, actually.
Thanks for listening to the Right Club podcast and joining our community of real estate investors online at therightclub.com, where the focus is about helping you grow. We look forward to seeing you again next week. Thanks from your hosts, Sarah Larby and Alfonso Salemi.